Hey guys, I'm just starting my second and new channel over here. My first channel is all about machine learning, deep learning and its application in finance and few other domains, and that channel will definitely continue. But I thought to start my second channel because I just wanted to discuss and share a few things around finance, investment, crypto, trading, investment banking, my real passion and where I spend a large portion of my career. So let's see how this goes. So today I'll start off with a little news around FASB and LIBOR, that Financial Accounting Standard Board, that is FASB, allowed companies to continue ignoring certain rules around modifying loan contracts and accounting for hedge of interest rate risk as they move away from the LIBOR, London Interbank Offer Rate. And LIBOR and other benchmarks underpin, you probably know, trillions of dollars of financial contracts, including corporate loans, mortgage, and interest rate derivatives. So during the shift that is moving away from LIBOR, most US companies have picked the Secured Overnight Financing Rate, or SOFR, as their replacement for LIBOR, which is being phased out after bankers allegedly rigged the LIBOR rate during GFC, that is around 2007, 8, 9. So the FASB initially gave companies relief in March 2020 in an effort to help them work through the large volumes of financial contracts they needed to update or renegotiate as part of their preparations to abandon LIBOR. On previous week, last week, on Wednesday actually, it voted to extend the relief, which is optional, of course, until 31st December 2024, past LIBOR's end. That covers the period through which banks can continue referencing existing US dollar LIBOR. So this relief loosens certain hedge accounting rules and reduces the effort needed to determine whether changes to a LIBOR-linked loan requires businesses to record that loan as a new one or as a continuation of an existing one. So before the relief, companies that project at least 10% changes in their cash flows as a result of modifying a loan had to record a new loan and book a gain or loss. But under the relief, companies that only changes the reference rate as opposed to a more substantive alteration such as extending the loan's maturity don't have to record a new loan. Basically, that means any companies that are only changing the reference rate and no other changes in the loan documentation, those companies don't have to book a new loan. So US officials last year supported decisions by the UK Financial Conduct Authority to allow banks to continue using US dollar LIBOR alongside LIBOR in other currencies for existing debt for an additional 18 months through June 2023. US banks stopped issuing new financial contracts using LIBOR at the end of last year though. And now about the adoption of SOFR. So the average daily trading volume of SOFR based derivatives have exceeded those linked to LIBOR each month since June. In September, the 3.99 trillion globally of futures and options contracts tied to SOFR changed hands each day, up from $207 billion in the same month last year, according to CME Group. And companies are also considering which version of SOFR to switch to from LIBOR. So term SOFR, unlike the also popular overnight version of SOFR, particularly benefits companies that borrow or lend in 1, 3, or 6 month periods and help project their interest rates. The preliminary rules suggest different SOFR settings with appropriate tenor spread adjustment for different instruments. For derivatives, this is SOFR compounded in arrears. For cash products and consumer loans, it is term SOFR, and for various contracts involving GSES, it is the 30 calendar day compounded average of SOFR. Now, while I said that SOFR penetration in the derivative market significantly increased this year, but a large share of leveraged loans are still linked to LIBOR. But many of these loans actually include fallback language referencing SOFR. So issuers who are planning to transition to SOFR when refinancing have postponed their plans due to the higher interest rate scenario that we are currently in. So with interest rates, unlikely to meaningfully decline before the expiration of LIBOR, issuers will need to address the LIBOR replacement directly in the loan documentation or rely on fallback language. Alright, I will end the discussion right here in this video, and do subscribe because I have lots of plans for this channel as well. I will upload videos quite frequently in this channel. And if you are into machine learning or deep learning and Python and its application in finance, do check out my other channel. The link of that channel is in the description. Alright, with that, see you in the next one. Have a good evening.